Picture this. It is early March 2026, and the silver community is on fire. The forums are exploding. The social media feeds are overflowing with charts and calculations and urgent warnings. The message is everywhere you look. 400 million ounces of open interest, only 100 million ounces of registered silver. The math does not work. The COMEX is about to default. Get your silver now before the whole system collapses. If you have been anywhere near the precious metals space in the past few weeks, you have seen these claims. You have probably felt the anxiety building in your chest. You have probably wondered if this is finally the moment we have been waiting for, the moment when the paper market breaks and the true price of silver is revealed. I understand that feeling. I have felt it myself. But today I need to tell you something that might be uncomfortable to hear. The COMEX default narrative, as it is being presented, contains fundamental errors. The mechanics are being misunderstood. The math that seems so simple and compelling is actually based on a flawed interpretation of how futures markets work. And here is the dangerous part. While the entire silver community is fixated on this default story, distracted by calculations that do not reflect reality, something far more important is happening in the background. The real story is not about a dramatic single-day collapse. The real story is about a slow, steady, relentless drain of physical metal from west to east. It is about governments stockpiling commodities as strategic assets. It is about ETF inflows signaling renewed institutional demand. It is about structural forces that are far more bullish for silver than any default fantasy. Welcome back to Mr. Ag. I am your host, and today we are going to do something different. We are going to separate fact from fiction. We are going to examine the COMEX default claims with surgical precision, expose the errors in the analysis, and then reveal what is actually happening beneath the surface. Because the truth, when you understand it, is more bullish than the fantasy. Grab your coffee, close the distractions, and pay very close attention. Before we dissect the default narrative, I need to know where you are watching from today. Are you refreshing your portfolio in a high-rise in Tokyo? Are you stacking coins in a basement in Melbourne? Maybe you are a shift worker in Calgary, catching this video before you head to work, trying to figure out if you should buy more silver before the system breaks. Drop your location in the comments below. I want to see how far our community reaches, because what we are discussing today affects silver stackers on every continent. The decisions being made in the COMEX vaults in New York ripple through the dealers in Mumbai, the refiners in Switzerland, and the manufacturers in Shenzhen. We are all connected, and understanding that connection is the key to understanding where this market is heading. Let me start by acknowledging the numbers that have everyone so excited. They are real. As of early February, the March silver contract showed roughly 400 million ounces of open interest. Meanwhile, the registered silver inventories in the COMEX vaults hovered near 100 million ounces. Those numbers are not fabricated. They are publicly available data that anyone can verify. And when you put them side by side, the conclusion seems obvious. If even a modest percentage of contract holders stand for delivery, say 25 to 50%, the exchange will not have enough registered metal to fulfill those obligations. The math does not lie. The default is inevitable. It sounds logical. It sounds compelling. It sounds like the smoking gun that proves what the silver community has believed for years, that the paper market is a fraud waiting to be exposed. But here is the problem. That logic fundamentally misunderstands how open interest and delivery actually work. Let me explain the mechanics, because this is where the analysis goes wrong. Open interest is not a static stockpile. It is not a pile of contracts sitting in a warehouse waiting to be converted into silver. Open interest is a flow. It is a constantly moving river of contracts being opened, closed, rolled forward, and settled. Every single day, traders are entering new positions and exiting old ones. Hedgers are adjusting their exposure. Speculators are taking profits or cutting losses. The number you see when you look at open interest is a snapshot of one moment in time, not a fixed demand that must be satisfied with physical metal. The people promoting the default narrative are taking that snapshot and treating it as if every single contract will eventually demand delivery. But that is not how futures markets work. The vast majority of open interest never results in delivery. Contracts are closed before the delivery period begins. Positions are rolled into future months. Only a small fraction of participants actually intend to take physical metal. Now let me address the specific claim that has everyone panicking. The 98% delivery rate. This number has been circulating as proof that something unprecedented is happening. If 98% of contracts stood for delivery in February, and March is even larger, then surely the system will break. Here is the issue. That 98% figure is based on a denominator error. The calculation takes the total deliveries and divides them by a single snapshot of open interest, but that is mathematically incorrect. It is like measuring the water flowing through a bathtub by only looking at the water level at one moment in time. You are not capturing the full flow. You are creating a distorted picture. To properly measure the percentage standing for delivery, you would need to account for all delivery-eligible open interest across the full contract cycle, not just a single-day snapshot. When you do that math correctly, the delivery percentage is nowhere near 98%. It is much lower. The alarming statistic falls apart under scrutiny. There is another critical error in the default narrative, and it involves comparing February to March. The assumption is that if February saw high delivery rates, March will be even worse because March has more open interest. But February and March are fundamentally different types of contract months. February is a minor delivery month. The participants who remain in the contract after first notice day are typically there because they actually want delivery. They are the serious physical buyers. The speculators and hedgers have already rolled out. March is completely different. March is a major month, one of the most active silver contracts of the year. It includes hedge funds, banks, and traders who use futures for hedging and speculation, not for physical delivery. The composition of participants is different. The intentions are different. The behavior is different. Historically, major months see lower delivery percentages relative to open interest, even though the total participation is higher. You cannot project February's behavior onto March. It is comparing apples to oranges. Let me go even deeper into the mechanics, because I want you to understand what actually happens when someone takes delivery on the COMEX. This is the part that most people get wrong. When delivery occurs, physical silver does not typically move. Read that again. The silver does not move. A delivery on the COMEX is a transfer of a warehouse receipt, essentially a warrant of ownership. The actual metal stays in the vault. Only the ownership changes. That same warrant can change hands multiple times without a single ounce of silver ever leaving the warehouse. So when you hear that deliveries are surging, it does not mean silver is vanishing from COMEX vaults. It means ownership is changing, not location. The metal is still there. It is still counted in the inventory. It just has a new owner. Now that new owner can choose to withdraw the metal if they want. They can request an armored truck, pay the fees, and physically remove the silver from the vault. Some owners do exactly that, which is why we see inventory declines over time. But the delivery number itself is not a measure of metal leaving the system. It is a measure of warrants changing hands. So what is the actual probability of a COMEX default in March? Let me give you an honest assessment. The probability is approximately 1 in 10,000. Maybe 0.01%. The COMEX has mechanisms in place to prevent defaults. They can adjust margin requirements. They can settle in cash if necessary. They can source metal from the eligible category, which is larger than the registered category. The exchange has every incentive to prevent a disorderly collapse, and they have the tools to do it. Now, I know some of you are frustrated by this analysis. You want the COMEX to break. You want the paper manipulation to end. You want to see the true price of silver revealed in a glorious short squeeze that makes every stacker wealthy overnight. I understand that desire. But here is the uncomfortable truth. You do not actually want the COMEX to collapse. If the COMEX exchange imploded, price discovery would freeze. Liquidity would evaporate. Regulators would likely impose emergency measures. Windfall taxes could follow. The government might even restrict private ownership of precious metals, as they did in 1933 with gold. A chaotic collapse does not help silver holders. It creates uncertainty and risk that could wipe out the very gains you are hoping for. Markets function best when they reprice gradually and fairly, not when they implode. The bullish silver case does not require chaos. It requires repricing. And repricing is exactly what is happening, just more slowly than the default fantasists want. Now that we have addressed the errors in the default narrative, let me show you what is actually happening. Because while everyone is distracted by COMEX default calculations, the real story is unfolding in plain sight. The fundamentals driving silver higher are more powerful than any single delivery month. They are structural forces that will play out over years, not days. And if you understand them, you will see why the current price is just the beginning. The first force is ETF inflows. Gold and silver-focused exchange-traded funds surged as much as 5% after softer U.S. economic data strengthened expectations for Federal Reserve rate cuts. Major funds like SPDR Gold Shares and iShares Silver Trust led the way as investors looked to increase their exposure to bullion. This matters more than most people realize. Unlike futures trading, ETF buying represents longer-term capital allocating directly to physical-backed funds. When you buy shares in a silver ETF, the fund has to acquire actual metal to back those shares. This creates sustained upward pressure on metal prices. It is not the hot money of leveraged speculators who will flip their positions at the first sign of trouble. It is institutional capital making a strategic allocation to precious metals. The move underscores a familiar pattern. When rate cut expectations rise, demand for non-yielding assets like gold and silver tends to follow. The money is rotating out of bonds and into bullion. This is the kind of steady, persistent demand that supports a long-term bull market. The second force is government stockpiling. According to Goldman Sachs, countries around the world are increasingly treating commodities as strategic assets, not just economic inputs. Nations are expanding stockpiles of critical resources including energy, industrial metals, and gold amid rising geopolitical tension and supply chain fragmentation. This is a fundamental shift from the era of hyper-globalized trade. Sanctions, trade disputes, and regional conflicts have prompted policymakers to prioritize security of supply over pure market efficiency. Strategic reserves are being built as insurance against disruption. Think about what this means for the silver market. When governments absorb supply into national reserves, less material circulates freely. The available supply shrinks, volatility increases, and prices tend to rise over time. Gold has already been a key beneficiary of this structural demand shift, with central banks buying at record rates. Silver, as the industrial cousin of gold, stands to benefit from the same dynamics as nations stockpile the critical metals needed for defense, energy, and technology. The third force is the slow, steady drain of physical metal from west to east. This is the trend that should have your full attention. While the COMEX default crowd is fixated on one delivery month, the real story is playing out over years. The inventories in London and New York are declining. The metal is moving to Shanghai, to Mumbai, to the vaults of central banks and industrial users who have no intention of selling. The Shanghai premium persists, indicating that physical buyers in Asia are willing to pay more than the paper price set in Western exchanges. This premium acts like a gravitational force, pulling metal out of the West and depositing it permanently in the East. Once that metal reaches Asian vaults, it does not come back. It is absorbed into strategic reserves, into industrial supply chains, into the generational wealth of families who measure prosperity in ounces, not dollars. This is the migration that matters. Not a single dramatic default, but a relentless, inexorable flow of physical metal from the paper casinos to the physical vaults. By the time the COMEX actually faces a genuine shortage, the metal will already be gone. It will be sitting in Shanghai and Mumbai and Dubai, owned by people who have no interest in selling it back to the West at any price. Let me tell you a story that illustrates why physical gold and silver matter when everything else fails. Lebanon is now in its 6th year of financial crisis. The banking system has collapsed. Citizens cannot withdraw their own money. The local currency has been largely wiped out. Savings that took a lifetime to build have evaporated. In this chaos, there is one asset that still holds value: Lebanon's gold reserves. The country holds approximately 286 tons of gold, among the largest reserves in the Middle East. Lawmakers have resisted selling this gold, viewing it as a last line of defense in a country where trust in financial institutions has completely eroded. For ordinary Lebanese citizens watching their banks steal their deposits while the national gold reserves remain untouched, there is a powerful lesson. When banking systems falter and currencies collapse, physical precious metals become the asset of last resort. They are the only thing that cannot be frozen, cannot be defaulted on, cannot be inflated away by desperate politicians. This is not ancient history. This is happening right now in 2026 in a country that was once called the Switzerland of the Middle East. And it is a preview of what can happen anywhere when trust in the financial system breaks down. Now let me address the volatility we have been seeing, because I know it has tested the nerves of many in this community. Silver experienced its largest single-day drop on record at the end of January. The move was violent and terrifying for anyone holding positions. But here's what the data tells us about that crash. It was not about a fundamental shift in outlook. It was about forced liquidations. Leveraged positions were being unwound into a relatively thin market. When liquidity dries up, silver can move sharply and quickly in either direction. The selling pressure was technical, not fundamental. And once that pressure subsided, the price stabilized and began to recover. At the time I'm recording this, silver has rebounded significantly from those lows. That is the nature of this metal. Silver tends to exaggerate gold's moves. It falls harder during liquidity squeezes, but it also rebounds more aggressively once the pressure fades. The volatility is a feature, not a bug. It creates opportunities for patient accumulators who understand the fundamental picture. The traders who panicked and sold at the bottom transferred their metal to those who had the conviction to hold or the capital to buy. This is how wealth is transferred in volatile markets, from the impatient to the patient, from the leveraged to the capitalized, from the weak hands to the strong hands. Gold, by contrast, has been remarkably resilient. It remains firm above $5,000, acting as the anchor while silver swings wildly around it. Investors are using gold as defense, waiting for clearer direction on rates and the economy. The divergence between gold's stability and silver's volatility tells you something important about market psychology. When uncertainty is high, capital first flows to gold for safety. But once the direction becomes clear, silver outperforms. The gold-to-silver ratio compresses as silver catches up and then overtakes its yellow cousin. We are still in the uncertainty phase. The jobs data is sending mixed signals. The Federal Reserve is watching every economic release. Geopolitical tensions remain elevated. But the setup for silver outperformance is building. When the uncertainty resolves, when the rate cuts begin, when the dollar resumes its decline, silver will not just match gold's gains, it will multiply them. Let me give you 3 scenarios for how this unfolds over the coming months. I call these scenario alpha, scenario beta, and scenario gamma. Memorize them, because one of them is playing out right now. Scenario alpha is the gradual repricing. In this scenario, the COMEX does not default. There is no dramatic collapse. Instead, the fundamentals slowly assert themselves over time. ETF inflows continue. Government stockpiling accelerates. Industrial demand grows. Mine supply fails to keep pace. The price grinds higher, month after month, with pullbacks along the way that get bought by patient accumulators. The headlines remain boring. The mainstream media loses interest. But the price keeps climbing, reaching new highs that seemed impossible just a few years ago. This is the most likely scenario. It is also the most frustrating for those who want instant gratification. But it is the scenario that creates sustainable, lasting wealth for those who accumulate steadily and hold through the volatility. Scenario beta is the supply shock. In this scenario, something breaks in the physical supply chain. Perhaps a major mine goes offline due to labor disputes or accidents. Perhaps a geopolitical event disrupts refining capacity. Perhaps an industrial user locks up supply with long-term contracts, squeezing the spot market. Perhaps a sovereign wealth fund decides to convert a significant portion of its dollar reserves into physical silver. In scenario beta, the price does not grind. It gaps. It jumps higher overnight, catching the shorts off guard and forcing a cascade of covering. The $100 level is breached quickly. The COMEX inventories decline rapidly as holders withdraw their metal before it is all gone. This is the low-probability, high-impact scenario. It is not impossible. Supply shocks have happened before in commodity markets. But it requires a specific catalyst that we cannot predict in advance. Scenario gamma is the extended consolidation. In this scenario, the current range persists for longer than anyone expects. The bulls get frustrated, the bears get confident, the headlines declare the silver bull market dead, weak hands capitulate and sell their positions. The price chops sideways, going nowhere for months. This scenario tests conviction more than any other. It is designed to shake you out of your position before the real move begins. The key to surviving scenario gamma is understanding that consolidation is not reversal. The fundamentals have not changed. The supply deficit remains. The industrial demand continues. The Eastern accumulation persists. The consolidation is just the market resting before the next leg higher. If you sell during consolidation, you will likely be selling at the worst possible moment, right before the breakout. Let me speak directly to the different types of people watching this video. If you are holding physical silver, I want to congratulate you for seeing through the noise. You are not waiting for a COMEX default to validate your position. You understand that the value of your metal does not depend on the paper market imploding. You own something real, something tangible, something that has served as money for 5,000 years. The COMEX could operate smoothly for another decade, and your silver would still be valuable. It would still be a hedge against currency devaluation. It would still be a critical industrial commodity. It would still be accumulating value as the supply deficit persists and demand grows. Your strategy is simple. Hold. Add on significant dips if you have the capital. Do not let the default fantasies or the volatility shake you out of a generational asset. If you are a trader using leverage, I have a warning. The volatility we have seen is not over. The market is headline sensitive and prone to sharp moves in both directions. A single economic release, a single geopolitical event, A single statement from a Fed official can trigger a 10 or 15% move. If you are leveraged 3 to 1, that move becomes a 30 or 45% gain or loss. One wrong trade and you are wiped out. The default narrative is particularly dangerous for leveraged traders because it creates a false sense of certainty. It makes you believe that the direction is predetermined, that the outcome is inevitable. But the timing is impossible to predict. You can be right about the long-term direction and still be liquidated by short-term volatility. Trade small, use wide stops. Accept that you will miss some of the move in exchange for staying in the game. If you're on the sidelines with cash, trying to decide whether to enter, here's my advice. Stop waiting for a COMEX default. Stop waiting for the perfect entry. Stop waiting for confirmation that may never come. The fundamentals are supportive. The trend is intact. The structural forces driving silver higher are accelerating. Waiting for a collapse that may never happen means missing the gradual repricing that is happening right now. Consider dollar cost averaging into a position. Make regular purchases over time rather than trying to time a single entry. This smooths out the volatility and reduces the emotional stress of watching your position fluctuate. And focus on physical metal, not paper promises. The whole point of owning silver is to own something real, something outside the financial system, something that cannot be defaulted on. If you are worried about COMEX defaults, the solution is not to trade COMEX futures. The solution is to own physical metal in your possession or in allocated storage with your name on it. The COMEX default narrative serves a purpose in the silver community. It keeps people engaged. It creates urgency. It reinforces the belief that the system is fragile and that silver holders will eventually be vindicated. And there is truth in that belief. The system is fragile. Silver holders likely will be vindicated over time, but the mechanism will probably not be a dramatic single-day collapse. It will be a slow, steady erosion of confidence in fiat currencies. It will be a gradual shift in capital from paper assets to hard assets. It will be a generational transfer of wealth from the West to the East, from the debtor nations to the creditor nations, from those who trust the system to those who see through it. The COMEX is a symptom, not the disease. The disease is the monetary system itself, built on unlimited debt and printing. The symptom is the persistent, nagging inability of the paper price to reflect the true supply and demand dynamics of physical silver. Eventually, the symptom will become acute enough that the diagnosis is undeniable. But we do not need a crisis for that to happen. We just need time. I want to leave you with a thought about what really matters. The silver community spends enormous energy analyzing COMEX inventories, delivery notices, warehouse movements, and open interest data. All of that analysis has value. It helps us understand the mechanics of the market. But it can also become a distraction from the bigger picture. The bigger picture is that the world is changing. The monetary system that has dominated since 1971, built on the dollar as the reserve currency and debt as the engine of growth, is showing cracks at every level. The fiscal deficits are unsustainable. The national debts are unpayable. The central banks are trapped between inflation and recession. The geopolitical order is fracturing into competing blocks. In this environment, hard assets matter more than they have in generations. Gold and silver are not just commodities. They are insurance policies against systemic risk. They are stores of value that have survived every empire, every currency, every financial crisis in human history. Whether the COMEX defaults next month or operates smoothly for another decade, the fundamental case for owning precious metals remains unchanged. The question is not whether the paper market will break. The question is whether you will be positioned correctly when confidence in the system finally cracks. I have prepared a complete technical analysis of the key support and resistance levels for silver over the coming weeks. It includes the price zones where institutional buying is likely to emerge, the levels where selling pressure will intensify, and the indicators I am watching for early warning signs of the next major move. I cannot cover all of it in this video, but if you want the full breakdown, the link is in the description below. Thank you for watching, Mr. Ag. If this video helped you see through the noise and understand what is really happening in the silver market, hit the subscribe button and the notification bell. Share this video with someone who is panicking about COMEX defaults or confused by the volatility. Drop a comment below with your thoughts and your location. The engagement helps this channel reach more people who need to hear the truth about precious metals. The default narrative is a distraction. The fundamentals are the story. The slow drain of physical metal from west to east is the reality. And the repricing, when it comes, will reward those who understood the difference between fantasy and fact. Stay skeptical, stay disciplined, and most importantly, stay safe. I will see you in the next one.